Ladies and gentlemen, welcome back. I'm still here, and I will be your host for a fireside chat with Rohit Sen and Omesh Fabiani. So, I'm very excited to be here. As I've introduced myself before, I'm Arzish Baaquie, CEO of Smartkarma. A bit of trivia that makes this a bit more interesting. Prior to my joining Smartkarma, my career was in M&A advisory, and at Smartkarma, I spent a chunk of my time building out the event-driven research vertical, an area which focuses heavily on trade structured around M&A. As you might have guessed by now, I have a very keen interest in this subject matter, and I'm very excited to get straight into it. I'm going to spend a few seconds introducing our two speakers. I know you're both raring to go, but just hold on for a few seconds. So firstly, Rohit Sen is founder and managing director at Tardis Capital, a Singapore-based boutique M&A advisory founded in 2013. At Tardis, Rohit advises issuers and businesses on listing on the SGX and on strategic M&A. He was an associate director at PwC in Singapore for 7 years before that, and a manager at Hutchison Telecommunications. He is a chartered accountant with the Institute of Chartered Accountants in India. Secondly, we have Omesh Fabiani, who is an executive director in the Financial and Strategic Investors Group at Standard Chartered Bank. He is responsible for the coverage of private equity funds, sovereign wealth funds, and other investors in Southeast Asia, primarily focusing on M&A advisory and event-driven financing in relation to their investment activity. Prior to Standard Chartered, Omesh was part of the corporate finance and M&A team at UBS Investment Bank, where he focused on M&A and ECM transactions in Southeast Asia. Gentlemen, thank you for joining us in this fireside chat. Let's jump straight into it, shall we?
Okay. Pleasure to be here. Thanks, Arzish.
Cheers. M&A deal volumes. Q1 2020 finished at a 5-year low. Q2 is looking bleaker than ever. What are your respective views on the ground in the industry?
I'll just start off and then Umesh can make his remarks. We saw that the first quarter, as per merger market news, the deal volume as well as the value of the deals are down 30% and in the Singapore market. And the circuit breaker had not even kicked in. So April to June should be fairly bleak because all of us are operating from home. So I don't think any of us are able to originate deals if we can continue to work on what we're working on. I think what could happen perhaps in the later part of the year is that investors would be prioritizing housekeeping a bit. So portfolio stabilization, looking at their cash flows. And the biggest risk any company will face is if they have any loans or borrowings which are coming for refinancing, because in this environment, getting refinancing on existing loans may not be that easy. And, certain subsectors may continue to do well. In healthcare, we saw that Dr. Anywhere raised 27 million recently. We've seen how Biolytics share price has been going up and up in terms of, logistics and all, because all of us are at home and all. So likes of Ninja Van and all, they just raised 124 million US. So those will do well. We saw Sheng Siong's share price has also been moving up because of this. Just two more things I would like to say, that one of the key drivers of M&A, I think, in the next 6 to 9 months, one could be privatizations. And this also, I would say that it will mostly will be driven by either hard assets. We saw some, news this morning about certain Singapore listed company in real estate. There's some talks there. And the other one will be when you have a deep pocket controlling shareholder. So he doesn't have to depend on, pure financing to getting it done. Finally, I would say that you would see a bit of structured transactions. And that could mean all kinds of things from convertibles and all that. Because we saw during the GFC also that one way of bridging the valuation gap was doing a structured and a convertible at a later date so that, both the buyer and seller can, in a way, kick that discussion down the road and can get the funding which the company needs. Umesh, please.
Yep, I agree. I think there's definitely been a slowdown in announced and completed deals, but there's definitely a lot of paddling under the water. Companies have been spending a lot of time kind of assessing and managing their own situations, and also thinking about how to approach this environment. COVID-19 has definitely added a lot of uncertainty to the prospects of companies, and also made just executing deals a little bit more difficult logistically. But we have to remember that, you know, before this whole situation, we were already in a pretty tricky environment where valuations had been going up for a long period of time, and a lot of deals were relying on very aggressive debt packages. So towards the end of last year, or across last year, where we had, you know, trade wars, Brexit, semicon cycle, and all that stuff, buyers were already starting to become more cautious and selective in thinking about what kind of deals they want to pursue. So as part of this situation, you know, I think buyers were already kind of pivoting their stance, and were sort of midway through preparing for a slowdown. But I think we'll start to see deals get done. Primarily two buckets. I think one where it's a deal, sort of a take private type of transactions where there's a lot of familiarity with the asset by the controlling shareholder who might take it private, or deals that are driven by liquidity requirements, given the cash flow squeeze that companies are facing for quite a long time now.
Thanks, Omesh. Thank you, Rohit. Let's shift our attentions now from potential deals, etc., to current M&A deals. So we've heard in the news, and we've seen it ourselves. Material adverse change clauses, etc., MAC and MAE clauses, deal breaks, lawsuits from sellers. There was a recent one where there's an American Express business unit, which Carlyle and GIC were going to buy, and they pulled out, and now they're being sued in court by one of the QIA subsidiaries, effectively. What are your respective thoughts on this? What's the risk here? And honestly, is COVID-19 going to be a legitimate material adverse change clause trigger?
Umesh, you want to go first?
Sure. So, I think the deal you mentioned might be one of the first highly publicized deals that where such a decision might be made. Although there are a couple of other outs being kind of contemplated in parallel. So we'll have to wait and see. The using of the MAC clause might be most relevant for deals that were signed before COVID-19 became widespread. So deals before December or January and are yet to close. Buyers in those deals, are most likely looking for a way to renegotiate or reconsider the transaction to the extent that the target has been significantly impacted. Using the MAC clause itself is generally a difficult way, and it would really depend on how the clause was defined, whether things like pandemics were covered, and whether you can make a case that the materiality thresholds were breached. But we also have to remember that for a long time it was a seller-friendly environment where it might have been difficult for buyers to really negotiate a strong MAC clause. So other aspects, other pre-closing conditions might be looked at where sellers are no longer able to meet and were previously agreed, and buyers may look at that. But I think in general, deals that were at an advanced stage prior to COVID-19 and have yet to close will most definitely face delays and at a minimum, renegotiations or revisiting certain aspects by both buyers and sellers.
Thanks, Omesh. Rohit, would you like to chime in, or should we push on to? Go ahead.
Just a quick one. I agree with Umesh that as far as that specific deal is concerned, many of us haven't read the exact clause, so one needs to get into that. I think what will also be interesting is that, and when during the last GFC, we did face one case where a sovereign wealth fund was trying to walk back on a particular deal. This was 2008 September, and unfortunately for them, they had transferred the money to the escrow account, so they could not walk it back. So that we got lucky. We were on the sell side then. But I think what will also be interesting now, is all the new deals which are being negotiated now, what kind of clauses, because since COVID has already happened, you cannot put COVID as a MAC going forward. So are you going to have things like, that unless if the situation doesn't improve, do I put it back to you? Would there be exit clauses? And also as a protection, I would say that you will see a bit more of co-investments and working with strategics, because strategics can always extract value, which perhaps a financial investor may not be able to always.
Thanks, Rohit. Thanks, Omesh. I think we've kind of inadvertently walked into my next question, which is, where are the buying opportunities, distressed M&A, specific sectors, geographies? I'd like to kind of effectively ask you to look at this from two perspectives. Rohit, I'd like you to look at this from a more strategic investor perspective or a corporate perspective, and I'd like Omesh to look at this from the financial sponsor, private equity perspective, if you would. Thank you.
Yeah, I'll start off. I'll speak about the Singapore context first. As compared to last GFC, if you see currently there have been changes in regulations which have an impact on how distressed assets are being handled. We had this section 211, which is very similar to US chapter 11, which we all have heard about. Many of us, we've just heard that this company is going for chapter 11, that company is going for chapter 11. What chapter 11 does is it does, rescue financing gets top priority over everyone else. So because if you go to a judicial management, what would happen is that the current board will be displaced. So that means the management is no longer in charge. Whereas if you go for the 211, you immediately get a 30-day moratorium. So it helps you manage your company a bit better. You're still in charge, you're still in control. And then you can work with your advisors to try and come up with a rescue package and things like that. So the key question here will be, how much value is left in the company? And when you get to a situation like a distress, if your value is based on your cash flow and your brand, then a lot of it will, go down very, very fast. Whereas if your value is linked to, hard assets or some long-term contracts or things like that, so then there is value there. So I think what one could see is that the companies which have a strong balance sheet can use this opportunity to do cherry picking, especially the strategics, where you can fill your gaps when you have, whether it's customer, whether it's products, or whether it's geography. This would give them a good opportunity to go pick up companies which may not have been available at the pricing that they could get because of COVID, because many of the young, say fast-growing companies may have stretched their financials in a way that they may not be in a position to sustain themselves during this.
Thank you, and Omesh, go for it.
Yeah, sure. So I completely agree with that, and some of that is very applicable to the PE space as well. So I would look at it as two buckets. One, there's a bucket of opportunities with companies which have been hardest hit right now. Tourism, leisure, discretionary consumer, and so on. And within this space, top players would be looking to consolidate or add capabilities, as Rohit mentioned. And I think private equity players who have portfolio companies within these sectors would most definitely be looking at bolt-on opportunities that make sense for their portfolio companies. But at the same time, there's also another bucket of opportunities with businesses that are doing okay or might actually be doing very well, such as those who can deliver their products and services online or non-discretionary consumer. And some of these guys are also looking for investment just to potentially accelerate their rollout or increase their scale. And as I mentioned before, there's already been a change in buyer perspective and selectivity in the kinds of deals they want to pursue in this tricky environment. And so with the broader shift in behavior, technology adaptation, and so on, I think from a PE perspective, there is a very strong focus on building a solid portfolio of of companies which are supported by strong secular trends on top of the more opportunistic situations that we might see in this environment.
Right. Understood. Thank you, gentlemen. I'm going to ask a question to each of you specifically, and it's more in relation to your particular roles. Rohit, let's start with you. The role of the independent advisor, what value can they add? And playing a bit of a devil's advocate here, why not simply insource the role? Plenty of ex-M&A bankers out there who could join a corporate and lead transactions, etc. in-house. So what is the real value add of the independent advisor in this context?
Okay, yeah, good point, and that's the basis of my existence in a way. So I should address that. So see, one, there are quite a lot of freelance introducers running around, and in one way, I mean, we want to differentiate between introducers and advisors because there are too many people who will come and tell you, "Oh, I know this one and I know this." So all they're doing is matchmaking, and then if things get a bit technical or a bit difficult, they're nowhere to be seen. So that aspect is there. I was with PwC for 8-9 years. We worked on some very interesting deals, a lot of leverage buyouts and all that. So the reason I wanted to set up Tardis Capital is that two things. See, in our business, and I'm sure Umesh will agree also, knowing the business owner is the key. Right. I mean, while we go through a situation where we think capital is important, but for a quality asset, capital, there are a lot of options. It's only when your quality drops a bit, then everything disappears. Then you're looking to raise money and it's tough. Right. So the idea is that if you can get access to quality business owners, quality businesses, that is what will drive things going forward. Right, and we thought that when you it's just I thought that when if I'm in an independent setup, I can focus on my overheads are more manageable than a larger setup, and I have a bit more time to invest in the relationship as it develops. So in the last few years we've done privatizations. We are currently listing 3 companies on the SGX. So COVID-19, of course, didn't come at the right time. So, and on top of that, we've done work in healthcare, consumer, all these spaces. The key thing, that is something I think anyone who has good technical skills and relationship skills should be able to do is to develop relationship with individual business owners and nurture that relationship. And when you talk about business owners, they're not doing a deal every day. They may be doing a deal today, they may be doing 1-2 years later. So for them to have it insourced means it's a fixed cost. Whereas unfortunately, as you know, for our industry, most of the earnings we get is more or less on success basis. So it's a bit of feast and famine. So business owner can, continue to engage. So for example, one of my clients, I think we did 2 or 3 acquisitions in the last 5 years, but we may have looked at 20 or 30 companies in various countries. So in a way, for him to look at those does not come at a significant cost. And as a business, we know we've made money from this relationship. I don't need to charge him every time he asks me, do you think this is interesting, or can you find me something which is in this space?
Understood, Rohit. I think you made a very good case for the independent advisor. No prizes for guessing my next question. Omesh, the role of the investment bank. Let me put this out there. The role of the investment bank, where do they add value? Again, playing devil's advocate here. There's been a very, very strong emergence of boutique advisories in the past decade or so, from your Moelis's and your Greenhill, Evercore, even PJT Partners, for example. Do corporates turn to investment banks for high quality M&A advisory, or are they simply turning to banks because the banks have the balance sheet to support these potential transactions?
No, I think that's a fair observation and a good point. I think from if you see the bankers who lead a lot of these boutiques, they might have spent a substantial amount of time at an investment bank previously, and could put potentially provide a similar quality of advice. So I think, from an advice and execution perspective, what we're delivering could be similar. And that is very important to companies, just because there's so much that goes into an M&A transaction, and it would be overwhelming for management. The last thing you want is for them to drop the ball on their day jobs while the company is being sold. But I think two differentiators are, for a global bank, there is a global footprint, a global network of clients that we speak to and have that strategic dialogue with on an ongoing basis. So there's a very strong familiarity or knowledge around the market, where potential buyers and sellers are from a global perspective and a cross-border perspective. The other main point I would just point out is that there is access to multiple product capabilities. So you can think about solutions to your clients from a more holistic basis. If they want to sell a deal, if they want to sell an asset, is the trade sale really the best way, or is it an IPO, or is it a securitization? Do you want to try some of these in parallel? Is financing required? Is hedging required? We can do that for you as well. And sometimes when you have all these different considerations being taken care of by a single advisor, it becomes a lot easier to coordinate and efficient. And so that's I think that's one of the key things that a broader platform could bring to the table.
Great, Omesh. You've made an equally strong case for investment banks, and now I'm completely torn. I'll take a few questions from the audience in a few seconds, but I think I have one or two more questions I want to kind of plow through. Valuations. So we've hit lows on valuations in certain sectors and certain geographies. Should sellers wait for a rebound, or should they take what they can get now? And the opposite question for buyers: should they buy now or wait for further valuation depression? Go ahead.
Sure.
See, the biggest issue with valuation today is that if you think of EV, in a way, okay, let's think of all valuation is forward, right? Historical is historical. So if I look at a EV, EBITDA or a PE, what should the EBITDA be and what should the earnings be? I think the whole issue will be now is that none of us have very clear visibility. If I want to value a company, what will be its earnings at the end of the current year? And obviously, because of COVID, there will be an impact. I think the biggest thing will be, I think, the people who have holding power will be able to get a deal. Like, Omesh will also tell you that M&As tend to happen. The question is that, is the buyer strong or the seller strong? And depending on who is strong, the deal terms are dictated based on that position. So what we think is that the sellers generally, so if say, for example, take Singapore, if our circuit breaker ends in May and June, we have somebody has a reasonable year, July he has a reasonable year, he'll want to say, okay, take these 2 months and prorate it for the year, and that is my maintainable earnings, and give me a valuation based on that. And the buyer will say, not so fast. So you will have those gaps. I think the key issue, two things will be important. If the business model is so strong that even in this environment you're making money, so those people will get a premium for their business model, and everyone else, if they have holding power, they would be able to wait and get the right value, or you can go back to the distress situation. Umesh.
Yeah, So I agree with those points, and it's a difficult time to think about valuation. It's also difficult to time the bottom and expect the companies that you like to be available when you want them. I think that's a little bit of an opportunistic situation. But I would just say that there are a lot of companies right now who need to act regardless of where the market is. And I think there are buyers also who want to take advantage of the current situation to secure an investment in a solid company that might not otherwise be available. So, I think now is the time to act. It's good to have dialogue, and buyers and sellers can consider options such as convertible bonds or pipe deals, where buyers may be willing to pay a little bit of a higher price in exchange for downside protection, employ earnouts, so that the performance risk is balanced out. or from for strategic transactions, consider mergers or share swaps where you're thinking about relative valuations as opposed to absolute valuations.
Understood. Thank you, gentlemen. I'm going to ask you some questions that have come through to us from the audience. First one is for Omesh. Omesh, what is one digital push, if any, that you're seeing in the corporate finance team of your firm? Should I repeat that, or you got that?
Digital push, did you say?
Yeah, what is one digital push, if any, that you're seeing in the corporate finance team of your firm? Something to do with due diligence, or anything like that, or any other digital pushes that you're seeing in your firm? Corporate finance specifically.
Sure. I think there are a number of initiatives that we tend to look at. A lot of it is pushed via our SC Ventures platform, or otherwise there's a big push to include digitization, and both in terms of mining for deals, looking for trends, as well as how we can employ that in terms of making due diligence a lot more efficient. So as you know, there are a number of third-party providers who do that, and we look to make use of those tools to help us along the process.
I mean, out of curiosity, as an extension to the question, are either of you currently on transactions where the due diligence is completely shifted to the cloud and online, and basically you don't have these old meetings where you have site visits and factory visits, etc. Everything's being done online. What's your kind of respective experience in that particular piece?
Let's take that. See, in terms of due diligence has moved to virtual due diligence for a while now. So,
sure.
So when I started in this industry, there used to be those one room with like tons and tons of files. So
it's quite a while back.
Yeah, so you don't see that much of that anymore. And so all the projects we are working on, everything is virtual, Zoom or BlueJean or.
So factory visits, etc. as well, all these kind of things.
Those are the ones where the virtual factory visits, I don't think has started yet, but I guess, in some cases, what we've done is, in case it's an overseas thing, so that it's not a replacement for the factory visit, but it just shows you around that, okay, the thing exists and all that. But it's unlikely, I would say, that somebody will do a virtual tour of a factory and complete a deal. I don't think we're there yet. But in terms of rest of the other things, documentation, discussion, all those things, I think the virtual world has taken over. Even, in fact, in some of our listings, we're working with the SGX also, and everything is, virtual and things like that. So
it's a new norm, basically.
Yeah, not right. Need to push the deals forward.
Yeah, well, you got to do what you're going to do. Omesh, anything to leave us with on that topic, or we're just about to run out of time?
Yep, sure. So, I think for us, it's still very much a hybrid. We make use of VCs and data rooms and access DD materials via the cloud, but site visits still existed until the lockdowns. That is. Right.
All right. We'll see what lies ahead for M&A in that context. Gentlemen, thank you for your time. We've run out of time, unfortunately. Rohit, Omesh, it's been an absolute pleasure. I really hope we can do this again sometime, hopefully in person. And
thanks for having us.
Cheers. Thank you, everyone. Thanks to the audience as well.
Thanks
I will pass it back to Amanda. Cheers. Bye-bye.